As a dividend growth investor, my goal is to build a reliable stream of income that grows over time. And I'm not just talking about high yielders here, I'm talking about companies with strong financials, consistent dividend growth, and the potential to keep on growing for years to come. So today, I'm going to share with you my top 3 positions that pay me over €1,000 in dividend income every single year. So if you're looking to build a portfolio based on safe dividends, you're in the right place. See you on the inside. First up on my list is ASR Nederland, ticker symbol ASRNL, and they are trading on the Dutch Stock Exchange. So ASR are an insurance company, and if you listen to the podcast, you will know probably over the last 24 months, maybe 18 months, we've been buying insurance stocks really heavily because they've been trading so cheap. ASR offer a wide range of financial products. They offer everything from non-life insurance, occupational disability insurance, health insurance, life insurance, pension insurance, pretty much any kind of insurance you want, ASR will do it. Now, ASR currently trade at around €47.91, but my average buy price is around €43. So you can see I've done quite well in terms of capital appreciation. But that is not my main goal. My main goal is income, and they pay a nice dividend yield of just over 6%. I own a total of 186 shares, which gives me approximately €550 in dividend income every year. But as the top company in my portfolio, the question is the dividend safe? Well, let's have a look at their dividend policy. In 2022, they have said they have a progressive dividend policy for shareholders. The dividend is determined discretionary and is not tied to any single financial performance metric. They also announced in 2022 that they aim to pay mid to high single-digit growth until 2026, which is next year. And then after that, they're expecting to pay low to mid single-digit growth. Now, one thing I learned from Enegas is not to always trust what management say. It sounds nice on paper, and so far they have lived up to that expectation. But you really have to dig into the financials to make sure that that dividend is safe. So what's my investment thesis? Well, I like to try and keep this as simple as possible, and being a Dutch company, I had to rely on European DJI a little bit. Let's face it, he knows the Dutch people a little bit better than I would. So ASR is that typical boring insurance business that kind of helps you sleep well at night. Dutch people, and I didn't know this, but Dutch people are very risk adverse, and it's not uncommon for them to be double insured, which is kind of crazy to me from Ireland because that's definitely not the case. But knowing this, there are still quite some opportunities for growth out there, particularly with technological advances and acquisitions. And ASR have been really positive in this regard with acquisitions, particularly with Aegon over the last couple of years. With that, they have solid cash flow generation, a healthy solvency ratio, which helps with the dividend safety. Add that with a high dividend yield and high dividend growth, it makes them a really attractive investment case, particularly if you can buy them around the low 40s. Of course, there's always some risks, particularly in this industry. You have strict regulations, particularly from governments and the EU. Let's be honest, we like to regulate. And actually going back to prolonged periods of low interest rate can hurt ASR's income. They are typically a cyclical company, so that's just something to be aware of. But as I said, they have a healthy balance sheet, really good solvency ratio, so I'm confident that their dividend is safe enough over the next few years. The second biggest position in my portfolio is Agree Realty, ticker symbol ADC. Now, Agree Realty is a triple net lease real estate investment trust. Think about Realty Income. They're pretty much similar, just on a smaller scale. And their top tenants include companies like Walmart. Actually, I believe that their tenants are much stronger than Realty Income's. If you want to know more about the company, I did a deep dive on these roughly about a year ago as part of our premium newsletter. But the good news is this is free for everyone. So I'll drop a link below. All you have to do is sign up and you'll get an example of a couple of deep dives, and Agree Realty is one of those. Now, I own roughly 122 shares of Agree Realty, and I've been buying them at an average price of around $60.79. You can see all these little blue circles are when I have bought them. And most of the ones that are up here at this height at around $70, that is automatic drip, which Interactive Brokers allows me to do for US companies. It's a shame they don't let me do it for European companies, but I do like to take advantage of it with some of my US holdings, and Agree Realty is one of them. And saying that, their annual dividend payout is $3.04, which gives me roughly $370 in annual dividend income. You can see with these two companies, ASR and Agree Realty, I'm getting very, very close to the €1,000 in dividends every single year. So, what is my investment thesis in Agree Realty? Well, like I said before, they are often referred to as Realty Income's little brother, and that is for a very good reason. They follow a similar strategy, but like I said before, I believe they have a stronger tenant base. They have a really strong balance sheet for a real estate investment trust, and they have no real interest-bearing debt until 2028. And lastly, Agree Realty's dividend history, while not as pristine as Realty Income, I agree, it is supported by adjusted funds from operation growth. And actually, our good friend Russ had the CEO of the company, Joey Agree, on his own YouTube channel, and he was kind enough to ask a question on behalf of us. So I will drop the link to that YouTube video below, so please check it out if you haven't. But as always, there is always some risks, and particularly from a company that has cut their dividend before, the question I always ask myself is, will they cut their dividend again? Now, I have to say, given I had already mentioned that the CEO was on Dapper Dividend's YouTube channel, he gave me peace of mind that he's not going to cut it lightly. And they are growing adjusted funds from operation, and there's no interest-bearing debt until 2028. So I'm confident it is safe, at least in the short term. But are they truly recession-proof? Now, that is a good question. We hear a lot about real estate investment trusts like Agree Realty as they focus on essential and non-discretionary businesses. And that has obviously some associated risks, such as bad locations, negative cash flows, high vacancies, problematic tenants. And you just have to look at what happened with Walgreens and Realty Income. But like I said, they have a far better tenant basis than Realty Income, with a lot of their tenants actually investment grade. So it gives me a little bit of peace of mind. But like I said before, I'm not really worried. I think it's a solid business. I think they have solid tenants. They've given investors an 11.9% compounded average annual return since 1994. And for us dividend growth investors, 5.6% dividend growth rate over the last 10 years. And I have an average yield of just around 5% in these, so not too bad. The third company on my list is British American Tobacco. Ticker symbol BATS if you buy it on the London Stock Exchange, or if you're like me, I bought it on the New York Stock Exchange as BTI. There's no real reason why I bought it on the New York Stock Exchange other than when I started investing and I didn't know a whole lot. This was probably one of the earlier companies that I bought, and I initially bought them on the New York Stock Exchange. So to keep things consistent and easy for me to track, I just kept adding to that position over time. So British American Tobacco is, as you guessed it, a tobacco company, and we all know the risks associated with that, particularly as traditional cigarettes are declining in sales. But one of the most important things that British American Tobacco did was acquire Reynolds. Now, this was a pretty big acquisition back in 2017 in a deal that was worth $49.4 billion. And it positioned British American Tobacco as one of the largest publicly traded tobacco companies in the world. Now, this was good because it enabled them to get into the highly lucrative US market. But the downsides to that is it added a lot of debt to their balance sheet. Now, I own a total of 197 shares of British American Tobacco with an average price of $33.95. That gives me an annual dividend income of around $585. Their current dividend yield is 7.14%, and their dividend growth rate is quite low, it's around 2%. The question is the dividend safe, especially for a company that has declining sales in their main product and such a high dividend yield? Well, let's look at our dividend policy. The board oversees an active capital allocation framework for reinvesting into our business and growing new categories, maintaining a sound balance sheet. I don't know if you'd say sound balance sheet, but that's their opinion. But they do want to continue to grow the dividend. Now, typically, they grow the dividend in line with free cash flow growth, and their payout ratio is generally around 65%. That said, I am confident that the dividend is safe. I'm also confident in their strategy to transition away from your traditional combustibles and more into this new categories. And they've shown over the last few years that there is promise in this, especially as they broke even in some of the new categories over the last couple of years. So it doesn't come without risks, but as I said, I believe the dividend is safe over the next few years. So there you have it, my top 3 positions that pay me over €1,000 in dividend income every single year. And honestly, I was quite surprised to see both Agree Realty and British American Tobacco in there, because in terms of cost basis and what I bought, they were not my top 3 positions, but they've grown into that position, particularly British American Tobacco, over the last couple of weeks due to their recent run-ups. But that said, I hope you enjoy these type of videos. If you do, please consider leaving me a like and maybe even subscribe, and we will see you next time.